This is a short recording of a Section B question from the September-December 2023 exam. It was a question that was actually done very well, and this debrief is not going to be very long because many of the calculations involved here are quite straightforward. It's a question where you're being asked to evaluate financial performance and a company's business situation, and to discuss any omissions in the data provided. 10 of the marks are available for calculations. So these headings would be quite sensible to put into your word processor to make sure that when you write out your answer, you pick up these omissions. So this sort of performance appraisal question does come up in advanced financial management with some regularity. And what you're expecting to find are some summarized financial statements, which we've got here, which we're going to use to do an analysis. And the analysis will involve a number of ratios. The first exhibit sets the scene, so let's just expand this, and we'd spend about 20% of the time available reading through this sort of data and highlighting key points. So here we're told that we're looking at a company that's a restaurant. In the first paragraph, we're told it's trying to offer a better dining experience. In the second paragraph, we're given 3 segments that it operates in, and we're told that there is considerable concern about maintaining dividend levels and responding to competitive threats, particularly in the 6 large cities, which is one of our business segments. And we're told that the move into tourist centres, which is another business segment, was relatively recent. And then we're given some financial statistics. If we're going to do some ratio analysis on these, it's going to make a lot of sense to take all of them and to copy. So Control C, open up the spreadsheet and drop them in here, Control V. Once I've got that, it's very easy for me to do trend analysis and appropriate ratio analysis. For the trend analysis, you might pick up some key issues that you're interested in. It's not going to be every line, so perhaps revenue, profit and dividend. And then you can pick up the change in revenue year on year as a percent of the opening year or the previous year's revenue figure. And I can do the same for profit. So maybe that's profits after tax, or I could take any of the profit figures, subtract the previous year as a percent of the previous year to show the trend. And once I've got it for 1 year, I can copy it over, highlight it all, format as a percentage, and then I can start to do some ratios. And I might think about some key profit ratios. So perhaps profit margin, return on capital employed, and maybe some liquidity ratios, perhaps the current ratio. And then typically you'd also think about solvency ratios and some investor ratios. Not necessarily only these or exactly these ratios, but these are typical ratios that are used. A quick look at the data that I've imported. I've got some segment information. So I might calculate revenue per store, profit per store. That's going to be fairly easy to do. And I've got some industry figures. So I want to make sure that I'm measuring gross profit as a percentage, operating profit as a percentage, gearing, and looking at the ratios that I thought I was going to calculate. Gearing's already there. I'm going to make sure I've got gross and operating profit margin, and I'm calculating gearing already. So the bulk of your work is going to be completing these ratios, and I'm not going to do all of these on the screen now. I am going to pick out a few that weren't done very well. So first of all, gearing. Gearing wasn't done particularly well because the question tells you to use the market value of equity. So just expand that. We're given the gearing as non-current liabilities over non-current liabilities plus the market value of equity. So I need to calculate the market value of equity, which I'll just do in here. And that's going to be a fairly straightforward calculation. It's the market price of the shares multiplied by the number of shares. And they're $1 shares, so I can just take the ordinary share value given here and copy it over. Now I can work out my gearing for each of the years as non-current liabilities over non-current liabilities plus the market value of equity, which I've just calculated. Copy that over to the other years, format it as a percentage. Another calculation that wasn't done well was return on capital employed. This is a classic profit ratio, so you're probably looking to calculate it, and it's profits before interest and tax, so operating profit, over the book value of non-current liabilities and the book value of equity. Once I've picked that up, I can copy it over, format as a percentage. So you can see none of the calculations here are difficult. We just have to knit them together into a story, which we'll do in a minute. Finally, total shareholder return. It's a classic investor ratio, and this is calculated as dividend yield plus capital gain. So the capital gain I can calculate by looking at the market price per share. So there's a fall in the share price in the latest year, starting from 5.35. Format that as a percentage. Copy it over. And then I should also be looking at dividend yield as well. And dividend yield, I can calculate here. The dividend's constant every year. And the market value of equity I've already calculated. Copy that over. And then my total shareholder return is going to be calculated as dividend yield plus capital gain or loss. And here it's the capital loss. And I can copy that over into the next year. So I can see quite quickly a picture of a company that's not doing well for its shareholders, it's keeping its dividends steady, its profits are falling, its revenue is falling. And we've got some industry averages, but probably there's some missing data here, which we're asked to comment on. And leaping off the page to me would be, who are our key competitors? Do we really benchmark against other national restaurant chains? And it would be useful to have some information like market share as well. And once I've completed my ratios, which are worth half of the marks, I'm ready to actually do an evaluation. So going back to my word processor, the evaluation itself is going to require some paragraphs on profit, liquidity, solvency, investor ratio. So I'm going to have a paragraph under each. I'm then going to make sure I talk about emissions in the data provided. It's a simple area. We've already mentioned benchmarking against your key rivals and the use of market share data, and I would explain why that information is important. And in each section, I'm going to try to say why what I'm seeing with the ratios is happening and why it matters, especially if it continues. And that's the style that you're going to try and use in each section. I'm not going to build up a full answer here, but let's have a quick look at the solution for one part, solvency, where we're looking at gearing and interest cover. So here's a short paragraph in the solution, and I think this is a good example of the sort of style that you're trying to replicate. Instead of just describing the small fall in gearing, the section on solvency is saying that gearing has remained fairly static. It's a tiny fall. And this is due to the fall in non-current liabilities being matched by the fall in the market value of equity. And why is that happening? Well, it's the fall in the share price. So that's why we're seeing the trend. And then why does it matter? Well, if our gearing is lower than the industry average, which it seems to be, then why aren't we borrowing more? Surely this is something we should investigate. And then just developing that a little bit more, interest cover is actually going down. So maybe this is a problem. If we've got further falls in profitability, then taking out loan finance may be problematic. So that's an excellent example. Instead of just describing the trend, I'm saying why it's happening, and discussing why it matters. And I'll ask you to review the rest of the solution to see that style in the other sections for the other ratios. And that completes this short review of the question.